Hi, good afternoon, everyone. We'll be starting the webinar here shortly. And today we're going to be talking about Altus Market Insights Premium, our new set of capabilities that are helping our CRE customers identify opportunities to outperform the market. Just watching attendees slowly trickle in, and what we thought we'd start with today is just a quick poll and get some perspective before we get into the panel. So hopefully everyone can see the poll in front of them. What we're asking is really, what is your perspective on the growing utility of AI in CRE investing? So we'll give everyone a couple minutes here to respond and fill up the attendee list, and then we'll get going in with the discussion here. All right, so we have the result, and everyone picked the one that I now see we had a spelling error. You have been trying to keep up with the news, but have not used it yet. So that's actually a great response, because today we want to talk about some of the ways that we are leveraging AI and machine learning to start to drive unique outcomes from some of the analytics and data capabilities that we have. So I think we will get going here. As I mentioned at the start of the webinar, today we're going to be talking about a new set of capabilities that we are bringing to market under the Altus Market Insights Premium offer. Today, I am Matthew Bacall. I'm the offer lead for our Market Insights offers, and I'm joined by Sally Johnstone, who's the delivery lead for Market Insights Premium. The agenda for today, we will keep this pretty simple. We're going to start off with just an overview of some of the industry challenges and kind of summarize the feedback that we received when we talked to a lot of our fund manager, portfolio manager, and research customers in the US market about the challenges they were facing and how we could come about solving that. And that feedback fed into our design for this offer. So we'll go through that to start with. And then Sally and I will go through a bit of a discussion around how the capabilities that we deliver can be used to help inform a fund or portfolio selection, allocation, disposition decisions. That will lead into a Q&A at the end. So we're hoping to have a little bit of a discussion on some of the questions that come up in the conversation today. With that, we'll get into the actual presentation here. So, the industry challenges. The real estate CRE has been an industry that's been going through a lot of change. And if we just think of the last couple of years, there was a very strong market. We had COVID come through, create a lot of disruption, a lot of uncertainty. And then we've been in what has been a very competitive market with a lot of capital flows going into real estate. Obviously, with the current pressures, with high inflation and higher interest rates, there's been some uncertainty that's been creeping in to certain aspects or certain segments of the market. But some of the challenges that we saw before the recent spike in inflation are still present today, and that's fighting for scarce talent, capital flows into commercial real estate becoming a core asset in a fund management or an investment management strategy. Risk, obviously, today is really in focus, and understanding what are some of the attributes that are or factors, market factors that are influencing risk and opportunity. There's also been a drive towards more automation and improved use of analytics, and that's what we want to show today. But also in response to globalization, changing cost of capital, and the demographic and geopolitical shifts that have been occurring. All of this is been driving just a ton of change in commercial real estate. And at Altus, what we're really trying to solve for with our Market Insights offer is helping our customers make faster, more informed decisions. And the goal of this offer is to deliver the data, analytics, and intelligence such that research processes can be automated. Customers can spend less time managing and trying to enrich their own data sets and leverage our output capabilities, which ultimately is driving into the selection, allocation, and disposition decisions that clients are making on a daily basis. So from this offer perspective, we're bringing together a lot of our data assets, but we're trying to drive to faster decision making and bring market insights and analytics forward in a way that you may not be able to do on your own or with existing capabilities. For this offer specifically, we spent a lot of time talking to equity investors, fund managers, portfolio managers, asset managers, researchers, and drove down to some of the key challenges that we keep hearing about in the market. And for today, we're going to be focusing on selection, allocation, disposition, but the challenges that are being faced today are pretty consistent. And I'm hoping that everyone who's attending today can read these key challenges and it resonates with everyone. But a lot of time is spent finding, curating, validating, just making the data work. And there's what that means is you get less time to actually use it for decision making. Data is disparate, or data is stored in disparate systems. It's not connected, and that really slows the ability to make decisions. There's multiple data sets that are available in the market, and there's lots of good data out there. But the challenge is using it effectively. So sourcing data is becoming easier. We're bringing data together. We're making it work, but it's becoming challenging to use it. And some of the data that do exist in the market, they lag the market sources. So demographic data, economic data, in some cases that can be lagging the market by a year or multiple years. And there's traditional ways to forecast it, but the need we see today is one where people are looking to make faster decisions, which means you need to have the right data at your fingertips today. Ultimately, this all comes together to drive and striving to find outperformance. So finding alpha, but in today's markets, particularly managing risk, managing beta, making sure that the investment strategy that you are deploying is responsive to current market needs and challenges. So what we've brought together in this offer is leveraging the offer capabilities across Altus Group to be delivering a full service solution that effectively enables us to combine our data assets with the customer data and feed it into a machine learning engine. That machine learning engine is trained by a team of data scientists, and this has been an area of investment that Altus has been making, been heavily involved with over the last couple of years. But our acquisition of Stratum Analytics, of Reonomy last year, and our investment in our own data and analytics infrastructure is really enabling us to be delivering expert delivery and interpretation of the outputs from our AI and ML models that help customers basically take their data, enrich it in our environment, and come back with predictive analytics solutions in a matter of hours or days. Whereas historically, a net new data science project would require hundreds of thousands of dollars of investment, potentially in new data infrastructure, new data sourcing, hiring data science, and would take months to deliver with potentially uncertain outcomes. So what we're about to show you today, and we're going to walk through kind of overview of the capabilities we can deliver, is the fact that we can take customer data and seed our systems and deliver outcomes, predictive analytics, NOI forecasts, and market factor analysis in days. So to start the conversation, we're going to kind of go through that selection, allocation, disposition, and I'll kind of tee off each of these sections and hand it off to Sally to walk through some of the delivery and analysis capabilities we have that help solve the challenges. Now, selection is a big challenge in the market today. Certainly, there are investment opportunities available. There's a lot of uncertainty over the future direction. And one of the key feedback areas we had when we're talking to our customers is being able to rank and compare different markets very effectively and efficiently. So when as Sally, as we go through this, it'd be really interesting to show how we can now aid in the selection strategy by bringing some of the predictive analytics and our scoring metrics forward. So Sally, do you want to walk us through a bit of what we can do?
I'd be happy to. I'm just going to turn off my camera quickly. There we go. So We've created 2 market level scoring metrics that are predictive. We use the capital asset pricing model, which a lot of you will remember from college economics and finance classes, which it's usually used against equities and bond markets. We decided to use it against commercial real estate returns. And the first score that we're able to report is the alpha score, which is a risk-adjusted rate of return for specific asset types in specific cities. The second score that we've developed is beta, which is the asset and city combination sensitivity to the overall market shifts. What we discovered using these scores is that they are actually predictive of future returns. We found that fund managers sticking to markets with top quartile alpha scores generate annual returns higher than the national benchmark by anywhere from 50 to 150 basis points. We have extensive documentation and explanations of the back testing and the research methodology we did to prove this hypothesis. But basically, it's a score that's updated quarterly and delivers higher annual returns for fund managers that are able to use it. And if you want to go to the next slide, David. Clients can access these city-specific alpha and beta scores in a dynamic online map in our opportunity discovery capability in Market Insights Premium. We update this every quarter. I should note, we're using screenshots in this presentation because we discovered that there isn't a webinar software that can keep up with the live environment, and the lag was a little confusing. But if you're interested in seeing the offer in action, please do reach out for a demo. We'd love to show it off. So if you want to go to the next slide. Now let's say there's a handful of multifamily buildings in the Mid-Atlantic region that you want to evaluate. The first cut could come from the alpha scores for individual markets. So with an outlook for underperformance against the benchmark of around -5%, apartments that are in the New York metro area going up into Connecticut, northern New Jersey, probably could be moved to second tier consideration for now. They're not likely to do anything but underperform for the next few years. On the other hand, apartments in the Washington, D.C., Virginia, Maryland area are predicted to outperform the market by around 3%. So let's go a little deeper into Montgomery County, Maryland by clicking through to a census tract around Silver Springs. Here we go, Chevy Chase, okay. We've used machine learning to develop models, and we use a placeholder asset located at the centroid of a census tract so that we can provide extremely detailed information at that level to explain performance now and in the future. Because the attributes of the placeholder asset we used in developing the model are the same for every census tract analysis, it enables like-for-like comparisons with other neighborhoods and census tracts. So the first set of analytics we provide at the neighborhood level is based on a fair market net operating income predictive model. And instead of stumbling through net operating income, I'm just going to say NOI from here on. This model, this NOI model, was developed using our wealth of data around commercial real estate performance and commercial real estate attributes, combined with current and forecast macroeconomic and demographic information. So in addition to the fair market NOI prediction, we also project 1 and 5 year NOI growth. This particular neighborhood has a really good outlook for NOI growth for multifamily properties, with almost 4% growth projected for the first year and more than 20% over 5 years. The average 1 year growth projection in the master data set is actually less than 2% for the first year and 17% over 5 years. So this is a good performer. So our machine learning models also identify the specific market factors that are either driving up the NOI prediction over the baseline or pulling it down. These factors literally come up at a click on the census tract in question. Now, looking at this list here, you can see that the most important factor influencing this NOI prediction is that it's a nice community with high home values. Other factors that are important include a low vulnerability score, higher than average renter income, and a low ratio of permits per household. So oversupply is not likely to become an issue in the next few years. We found that there are other markets where there's a significantly higher ratio of permits per new household coming in, and that can really have a negative impact on NOI. So overall, the handful of factors that are a drag on the NOI for this area are lower population density than average and a lower percentage of renters in the local population. The market factors that are increasing the potential NOI of this location are external factors unlikely to vanish. The negative factors are not terribly concerning. In the past, this level of detail around factors driving performance for different regions was simply not available. You couldn't get this level of detail or this level of understanding about the market factors driving performance. Even now, the time and effort typically required to produce information like this can take weeks, but we produce the data instantly for faster, more informed decision-making. So let's take a look at another census tract. Other census tracts in areas have different outlooks due to exogenous demographic and economic factors. It's possible to examine any locations under consideration quickly by drilling down to the neighborhood level to compare the predicted and projected fair market NOI. Here we're comparing the previous tract, which had an NOI predicted of 19,000 plus, to another census tract that's about 1.5 miles to the northeast, where the NOI, the projected NOI, is actually about 6,000 per unit less each year for a building with the same exact size and age attributes. So this is a good example of how exogenous factors can affect outcomes, and we can measure it. So the market factors that are driving the lower NOI prediction explain why it's lower. It's not as wealthy a neighborhood, and renter incomes are lower. It doesn't mean that this location isn't worth consideration, because of course there's other factors to consider, like the price, cost of capital, fund strategy. But having this ability to look at areas side by side, like for like, apples to apples, does enable fast, consistent comparison between locations. I should note we've developed a model for industrial assets too, so clients can execute a similar selection workflow for that asset type. In the end, Market Insights Premium can significantly speed up evaluation and selection of potential investments. Before machine learning models like this were available, this kind of analysis could take weeks, but now it's literally a mouse click, and yes, it kind of feels like cheating when you can get it this quickly. So I'll turn it back, oh, excuse me. Turn it back to Matthew.
Right. Thanks, Sally. Now, selection was certainly is an area that we hear a lot of customer challenges around. There's historically, a couple quarters ago, there was a lot of investment opportunities, and kind of scoring, understanding which markets to potentially invest in was a big challenge. And to adjust the selection strategy. Now, when it comes to allocation, a consistent theme we heard was during quarterly review processes or annual business planning processes, the need to have quick predictive analytics to help guide future allocation decisions and understand which markets to remain in, which markets potentially to start investing more in or shifting capital out of. What was an area that was, there's a lot of time spent on, but sometimes the outcomes were never really certain. So one of the key challenges, and this is one of the bigger use cases for the capabilities we have today, is to help clients understand information and scoring around their own assets and how their individual portfolios, individual assets are predicted to perform in the future. This challenge is something that happens today probably more frequently than quarterly, as there's certain uncertainty creeping into the market, but it's something that we can deliver very, very quickly. And I think, Sally, you made the message just before we jumped to this section, that the kind of revolutionary capability here is we can deliver predictive analytics at a speed we've never been able to do before. Let's spend a little bit of time, I guess, can we walk through some examples of how these predictive analytics can help with that allocation strategy?
Yes, yes. So as a part of the delivery services we provide, we load clients' information for their properties into the machine learning models and create a fair market NOI prediction and projection, along with market factor analysis for each specific asset within a client's portfolio. And this, of course, is updated quarterly as the model is updated quarterly. So let's start by looking at the sample portfolio's balance of alpha and beta measures and over and underperforming assets. So when we look at this sample portfolio as a whole, you can see that there's relatively few negative alpha scores. For the most part, the properties here in this portfolio are in cities where their asset sector is expected to have higher returns than the benchmark average. This is a nice balance. And we can also look at beta score in this kind of balance. A handful of the properties in this portfolio have beta scores over 1.5, but the majority are near or even less volatile than the overall market. while in periods of growth, this conservative position might actually constrain returns because beta scores, of course, while they more rapidly decline your returns, they also more rapidly increase your returns in the case of an increasing market. So this might be too conservative a position in a growing market, but given the uncertainty of the market we're in right now and moving forward, overweighting toward a lower beta on average is less risky. So another part of our delivery service is producing comparisons of how your performance distribution compares to the master data set. Because that's always one of the first questions we hear from a client is, well, what does this look like? What's the average? What do other people do? What does it look like? We also compare your average growth rate and growth rate distribution to the master data set, so you get a feel for where you sit in that group. Over time, we'll track changes in allocation of risk, NOI over and underperformance, and potential for growth as part of our delivery too. So we update, as I said earlier, the Altus machine learning models quarterly as new performance information becomes available. And as soon as we ingest a client's most recent quarterly NOI and occupancy information, we update the client's portfolio predictions and projections. In other words, this is about as current as you can get. I should also, this is interesting. So this model is very sensitive to exogenous change. Just last week, there was an article that came out that reported multifamily operators were experiencing NOI compression. Our model started showing signs of this back in Q4 2022. In fact, I was, I'll say, a little worried when I started seeing negative growth projections. But then we realized the reason those projections were small or even negative in some regions was simply a reflection of expenses rising at the rate of inflation, but rent revenue lagging the change. So that was an early look into what might happen. It doesn't necessarily affect growth forecasts over 5 years, but it was 1 year forecasts that were becoming less, that were shrinking. So in our delivery, we also take deeper looks into individual properties, like this industrial asset, for example. We ingest the client performance data for industrial properties into a machine learning model that we trained using industrial performance data versus multifamily, which is what we were looking at earlier. And with this, we predict NOI, annual NOI per square foot. And we built a targeted set of market factors for the industrial model, which is different than the multifamily market factors, though there are some that overlap. So this asset, as you can see, is underperforming by 14.4%, the prediction, even though it's in a high alpha market for industrial. The alpha there is 4%, which is pretty good. Another metric to notice is that while its projection for 1 year NOI growth is -1, over 5 years, it's projected to grow by 24%, which is significantly higher than the average 5-year growth projection for industrial assets, which is about 18%. So next slide. So this industrial asset is underperforming, but the fundamental market factors, which we see here in this waterfall chart, that are driving the prediction are likely to support higher NOI and NOI growth, which is why the growth rates are so high, the 24% we just saw. So what we found is that lease timing is frequently the cause of an industrial asset underperformance. When lease timing is such that the client wasn't able to take advantage of the growth in market rate rents for industrial over the past few years. But if the lease is due to be renewed soon, it's likely that the NOI for this property will be more in line with the prediction, and it will be a stronger performer in the future. We can help identify other industrial properties in this portfolio that have the same pattern. Having this depth of information on every asset in a portfolio immediately available enables better, faster decisions around allocation. So next. So here we're looking at the predictive and projected metrics of a multifamily building located in an area with negative alpha. It's also underperforming the predicted fair market NOI by almost 13%. Its 1 year projected growth is negative, and its 5-year growth projection is just average for multifamily properties in the master data set. Let's take a deeper look at the factors driving that prediction. Here we're looking, so the factors driving the NOI prediction are actually external to the building. It's a densely populated area with high home values, high income renters, and a high percentage of renters in the area, and low chance of oversupply from new construction. About the only negative that we're seeing here, and it's minor, is that the building is a little older than average. So even though the top line metrics didn't look that great, if we want to go back a couple of slides. Now here where you're underperforming, your growth isn't that great, and the 5-year projected growth is average. If we go forward to the market factors that are driving the NOI are exogenous factors, and then one more, we'll see that these are actually factors that are expected to continue to grow. The median renter income growth will outpace US, growth in higher income renters will outpace the US, and median home value is going to climb. So while superficially this may look like not the greatest, it actually has good outlook for the future. And this is part of what we do when we do the delivery and work with our clients to provide the information that they need and the interpretation that they request to help understand how these numbers can be used to predict future performance. So.
All right, thanks, Sally. Now we're just going to pause for a quick poll question while we just get ready for the next section. So we've been showing some of the capabilities that we can deliver through Market Insights Premium. And what we wanted to understand is, out of these factors we can deliver from fair market NOI and NOI forecast, the market factor analysis, opportunity analysis, and alpha and beta scores, which one is of most interest in light of the current conditions? Let's give it a minute to capture some responses here. All right, not surprising. NOI forecast is obviously of interest, but market factor analysis and opportunity analysis were pretty close. And that's actually kind of a good segue into the last discussion that we're going to have, which is around disposition. Now, we started this process, as I mentioned, the market has been changing. We started this customer feedback process several months ago when the market conditions were quite different. And again, one of the common themes we heard, certainly from fund managers, was feedback around understanding which assets may be candidates for disposition, or which markets should there be exiting based on external market factors that they may not have readily available at their fingertips. And this is a really powerful use case for our non-traditional data sets around demographic and economic data, to be able to understand not only where underperformance is predicted to occur, but getting into the market factors of why we're predicting future underperformance. So in this section, Sally, I think we can go through some great examples of how the capabilities can help inform and build a business case around exiting a market or an asset.
So we're going to look at two potential candidates for disposition and talk about how real-time analytics can help inform those decisions about property disposition. The first property we're looking at here is a garden apartment in Atlanta, and its performance is pretty much on par at plus 3.7%, and its alpha is positive, plus 1.9%. But its 1-year and 5-year growth potential is lower than average. Its 1-year projected growth is actually negative, and 5-year projected growth is just over 10%. So let's look a little deeper into the market factors that are driving the NOI for this property. So the three things that are driving, that have a positive impact, are that most of the households in the area are childless, and therefore more likely to rent. There's low chance of an environmental threat, and the property was remodeled within the past few years. On the other hand, home values in the neighborhood are lower than average, and there's indication of economic fragility in nearby households. That's the one of the ways we measure that is by percentage of population with no health insurance. We found it's incredibly predictive of NOI growth. Both of those factors aren't likely to become positive in the near future. Home values and percent of population with no health insurance don't tend to move too quickly. So there's no indication here to expect that performance would necessarily improve in the near future. So let's look at another apartment in this portfolio. It's located in a high alpha market. 4.4% is good for multifamily alpha. This particular property is outperforming its projected fair market NOI by almost 24%, which is great, but its potential for growth is lower than average, again, negative, and it's about the same as the Atlanta apartment we looked at for 5 years. It's 13% versus 10%. But then when we go to the next slide, we can see that the picture painted in the market factors is rather stark. Once we see them, we'll see that the median home value is not good. It's not in a great neighborhood. The building age, it's older. It's pulling down that prediction. The median home value in the community is not terribly good. It's not densely populated. In fact, it has a lower density of population. The median renter income is lower. It even has this one here, new permits per new household. Again, there's a very real threat of oversupply in the near future. In general, even though this property's been overperforming the prediction, based on our experience, it's not likely to continue to outperform. So ultimately, of course, these decisions are based on more than just the external market factors and how we anticipate their movement. But these are good factors and predictive analytics to consider as you are looking at properties and considering disposition decisions. So identifying candidates for disposition has become a much more complicated process than it was in the past. So now opportunity to free up capital arises. Managers need the ability to make a data supported decision quickly. You need to have more knowledge than just, well, it's been in we think we're at maximum return for it. You need to understand where it's going to be going and whether this is the time to let it go or not. Because we update these client property predictions and projections every quarter, we provide an unbiased, data-based current evaluation of property's performance, as well as visibility into its future growth potential in just minutes. So.
Great, thank you, Sally. So what we went through relatively quickly was just a number of samples of some of the capabilities that we can deliver through Altus Market Insights Premium. And we walked through 3 real world use cases for those capabilities, from looking at the market from a selection, allocation, and a disposition use case. And just one thing I want to keep in mind what we walked through was just some demo data that we've been loading in the system. As Sally mentioned, the actual deliverables for this are customized to individual clients' portfolios, and the models behind them are actually adjusted by the machine learning models based on our constantly updating demographic and economic data sets behind the scenes. So our final poll question before we get to some Q&A is to just follow up and understand some interest in further discussion around this. So we'll post this for a minute or two, and then we'll get into some Q&A. All right, so if there are questions, what we're asking everyone to do is post their question in the chat, and we will, Sally and I will try and answer as many as possible. We have one question that has come in that we'll start off with, and it's around how the model variables, which basically how our models are developed. So the question is, do we change, Sally, the question is, can we change the model variables based on the market?
So the variable selection is done annually, and it's a rather complex process that we use to make sure that we don't have collinearity between variables, and that the variables are the most important in innumerable variables that could be chosen. When we built the models, that's what we did, was find the most important ones. We will rebalance the variables themselves annually because factors change. So, did that answer the
Great.
question, Matthew, or was there more?
I think so. That was good. We'll jump to one question that we do get very often, is, we're producing NOI forecasts on a 1 and 5 year basis. Question often comes up is why we didn't choose to forecast rent.
Okay, actually, there's a couple of different reasons. First of all, rent is very variable and seasonal, so it doesn't make a great target variable to forecast. NOI is more useful for purposes of comparing different factors, and I know I'm forgetting something, Matthew.
Well, I guess my take on that question would be, one of the reasons we want to forecast NOI is because that ultimately takes into account both income and expenses, and provides more of an outlook on what are the factors driving ultimately the asset performance. So looking only at rent obviously looks at income growth, looks at revenue growth, but can hide some of the underlying factors that may be influencing the asset's performance. Another question, can I add my own variables to the model?
Not at this time, no.
Now,
It doesn't mean that it isn't a potential for the future.
I think one of the key things is and maybe Sally, we should talk a little bit about the underlying data, especially in StratoDem. StratoDem combines analytics, StratoDem Analytics, sorry, combines about 220 economic, demographic, POI data sources together and creates nowcasts and forecasts of those data sets. I don't know, Sally, if you wanted to just chime in a bit about the power of those capabilities to really dig into some of the very specific underlying metrics.
Well, it's the granularity and the accuracy of the data that we're able to produce with StratoDem, in addition to the really, really accurate forecasting that the model produces out of StratoDem. The challenge with historic sources for demographic and economic data is that it's at too high a level of geography. It's at a zip code level or a county level when you really need to know neighborhood information. It also tends to lag. Some of the stuff coming out of census is 10 years old. We all know a lot's changed in the past decade. So what StratoDem has done is produced a way to come up with extremely accurate current counts of population or renter median income or household numbers, all of that, and incorporate that into the NOI predictive model, which just makes it much more accurate. We have plenty of studies that show the degree of accuracy with back testing and such.
All right, we've got some more questions coming in. Can we explain how the system collects data and validation? So I'll take that one. This offer is actually our first offer delivered through what we're calling the Altus Performance Platform. And this is a new set of capabilities that Altus has been investing in over the last 18 months around data management, data ingestion, data integration, machine learning, and with a common front end, a common UI that some of those screenshots were taken from. So the process that we're leveraging here is we're basically able to capture shared client data for the purpose of this solution, ingest it into our models programmatically, and after that, the data science and machine learning models really take over. So there is a validation process and just an error check process that occurs as we're bringing the data across. But for a lot of our valuation customers that are leveraging us for valuation management, that data has already been thoroughly vetted in that process. So it ensures that the data we're bringing into our models is already highly accurate, but has also been validated by a number of different processes and sources. I think that actually addresses one of the other questions that come up is how, what data is required, and this is information we can dig into on a more specific demo. But really, what we're trying to leverage as much as possible is the valuation data that, in many cases, customers is already sharing with Altus as part of our valuation management services. We are looking to bring in performance data where possible, and there are a number of specific attributes by asset class that we bring across. That's also a good segue into another question that came up, and Sally mentioned that early on in the discussion. Right now, we have built and trained models that support multifamily and industrial assets, and those two assets were chosen for a number of reasons, not least of which is the fact that they have been two of the strongest performing asset classes in CRE over the last number of quarters. Now, that's not where we're stopping. Those were the first two asset classes we brought across, and we are going to be expanding both our model capabilities and our predictive analytics capabilities over the coming quarters to move into additional asset classes. Sally, this is a question for you. How do you take into consideration risk factors in asset selection other than volatility? It's a tough question.
Well, there's a lot more to it than just volatility, of course, because you need to look at the entire, you want to look at your entire portfolio. How is it balanced? Am I on the East Coast, West Coast, middle, whatever? How close am I to shipping hubs? You want to spread the risk out. But beta as a measure is incredibly predictive of behavior of returns against a market benchmark. How much more, how much less it will go. Things like credit risk and things like that aren't incorporated in the model at this time. I'm not sure that answered the question. Was there?
Well, I think it highlights the approach. I think the follow-up on that is the delivery model here. And just to be clear, this is not a solution that we simply hand to customers. There's interpretation of the individual portfolio risks that's considered as part of the process. And that's really, that's where we can start to have discussions and additional analysis around other factors that may be outside of our models. A question came up, and we kind of answered it differently, but maybe we'll take a stab. And this is on variable selection. So the question was, to follow up on an earlier question, do you use different market variables in different markets? So might a variable like home market or home values be used to forecast NOI in Atlanta, but not in Nashville? So I think it's a question, Sally, really around how does our market factors, how are they created, how are they selected, and how are they used?
Okay, I'm going to step back a little bit and talk about data science and building a data science team and why sector expertise is critically important as you are developing models. We worked with a client whose data science team came back and said, growth in the labor force results in more renting. And it's like, and that's obvious. So there are other factors that may not be as obvious that are actually more predictive. So combine the simple, pure D, incredible expertise that Altus has around commercial real estate drove a lot of the selection of market factors. And then in developing the model, the way a machine learning model works is it's the weight of something like a home value is different in Atlanta than it is in maybe in Nashville. And Nashville home values may actually be pretty important. I don't know. I don't have it in front of me. But it's the model itself, because it is calculating the influence of each of these factors against the actual target variable, identifies and weights it appropriately depending upon the area. Some factors don't even show up in some areas because they are not important for predicting the NOI of an asset in that area. Other factors are incredibly important, and you're like, well, that is interesting that it's number one. Other places, home value is really high, and in some places, something like distance to shipping hub might be higher. So it's all variable, and that is the beauty of machine learning, is that it adjusts to external factors and internal information to deliver the information that is quantifiably important.
I think it's also important, Sally, just to add to your question or your answer. That's one of the reasons we actually are delivering. We made the decision to deliver this quarterly and on a recurring basis, because over time the weighting of individual market factors will change, and our underlying models that are powering some of the demographic and economic nowcasts are being constantly updated. In some cases on a monthly, some cases quarterly basis, and those will start to drive more unique outcomes. So just let me take a look and see if we got. We'll take one more question and then we will wrap up. There's a question on data. Where's the data coming from? How big is our data pool? A series of questions. Where do we get our data from? The data we're using is coming from a number of public and private data sources. So within, what's powering underneath all of our data is Stratum Analytics, which is a data platform that captures a number of different economic, demographic, and POI attribute data sources together. We also have other data that we have available. We acquired Reonomy last year, which has a number of data sources, and that asset data is going to be brought into our model. But it's also around some of the anonymized data that Altus collects through other practices that we do have the data rights to be anonymizing and using in our underlying models, combined with other third-party sources we have the rights to use to power a very, very large data set. And it's something that we'd be happy to discuss with customers on a one-on-one basis as we talk more about some of the capabilities and the models that we develop. But really, this is a combination of third-party sources that we have licensed for specific uses, some of our internally generated and anonymized data sets, as well as public data sources combined together. And that's one of the reasons we're starting in the US market with the solution is the region in which we have one of the largest coverage and access to the most data. All right. Actually, I lied. There's a couple questions coming in before we wrap up here, Sally, and I'll give you last word. There's some questions around roadmap and different asset classes. So I think I already answered the question. We started with multifamily and industrial because that's where we found one of the bigger needs and one of the opportunities for our data. We are looking to capture additional asset classes. So the roadmap goal is to service certainly the four major asset classes within CRE, but also expand into some of the other asset categories. Now, this is where we're producing our NOI forecasts and market factors. We can leverage some of the existing capabilities we have within Altus, such as Stratum Analytics, to be building neighborhood modeling tools and forecasting tools to help aid in selection or disposition for other asset classes, such as retail, alternate asset classes, life sciences. And that's something we'd certainly be happy to explore today. So we're starting with these two asset, sorry, say that again. We're starting with multifamily and industrial. We'll be expanding, but certainly, after the webinar, if we're very much open to feedback on where we should be going, which asset classes are critical. I know everyone is probably interested in an office forecasting model. It's something that we are exploring as we speak, and we're happy to share more information as we go. So I think as we come up to the wrap up here, I want to thank everyone for attending today's session. A recording of the session will be made available for everyone who attended to follow up any additional, any points we went through too quickly or any kind of critical items you may have missed. But really encourage anyone who's interested in learning more, reach out to your sales rep or to anyone at Altus Group to request more information. We'd be happy to discuss more about how these capabilities can be used to help aid in a fund strategy, in your selection, allocation, disposition decisions. And ultimately, our goal is to help deliver outperformance. So leverage our NOI forecast, the market factor analysis to make faster, more informed decisions as you're thinking about your asset allocation, your market allocation strategy, and to start to help customers deliver outperformance. Thanks, everyone.
Thank you.